Canoe slalom, you're in whitewater, and the conditions are always changing, rapidly. There are plenty of challenges, upstream and downstream, and momentum matters. You want to navigate the course as quickly and strategically as you can. To me, reach is about what you go for and how you go for it. That's where the remarkable is possible. To reach with confidence, you need to build proven expertise, master the big picture of the course, and then the small technicalities that will help you win. Be clear what guides you, what your values are, and let that shape your every move. Be principled in your execution, and have a team around you who truly care about your journey and making it the best it can be. A personalised experience. Then, together, reach for remarkable.
Good afternoon, everyone. I would first like to acknowledge the Gadigal people of the Eora Nation, the traditional custodians of this land, and pay my respects to the elders, both past and present. For those of you who don't know me, I'm Daniel Cave and I'm privileged to lead Grant Thornton's National Corporate Tax Team. It is my absolute pleasure to be here with you all today to look into some of the key changes from last night's budget. We will try and look at some of the material tax changes and try and find some of the winners and losers from a tax perspective from last night's budget. And I'm really glad to welcome here today two of my fellow partners. Firstly, Anika. Anika Reside is a partner in Grant Thornton's National Indirect Tax Team and specialises in GST and fuel tax. Anika, welcome today. It was a quiet night for you last night.
Thanks, Daniel. Yeah, they tend to be on federal budget night when you do GST and fuel tax credits. There normally isn't too much to talk about. So yeah, I did have a bit of an easier night than both of you.
But I'm sure you've got some pearls for us later. I'll also welcome to my right Christine Cornish. Christine is an experienced tax professional who focuses on transfer pricing and has over 20 years of experience working in professional services and in some of Australia's biggest businesses. Christine, welcome. There's something stinging the tail for multinationals from last night?
Yeah, there's a little bit in there. It was an interesting budget. Lots of stuff in there from a broad perspective. Tax a little bit light on, but you know, that's not an overly surprise. We've seen that the last few years, but definitely a few things that are definitely of note for multinationals.
Looking forward to finding out what they are. Thank you. Just a housekeeping reminder, please submit your questions in the Q&A panel. We'll try and get to them in the presentation later on. We're getting a live feed put in front of us. If we don't address your questions live, we will try and get back to you later. So please welcome some interaction. Let's start with my first take from last night's budget. There's no doubt that this is a budget focused on the individual. There is a lot of targeted cost of living measures that have been introduced for individuals and households. We've got tax cuts, we've got energy bill relief, we've got student loan relief, we've got cheaper medicine. It's a lot targeted at the individual level. And in contrast, compared with prior budgets, there are very few measures targeted at business, particularly medium and large business, who are, should I remind you, the largest employers of our economy. Unless you're in the specific critical minerals industry or the hydrogen, green hydrogen, there really isn't a lot for business in this budget. But I guess my biggest overall question is, while there's no doubt that this does try to attack the cost of living crisis at the individual level, and that does seem sound policy, what is going to be the impact of putting more dollars back in people's pockets? And what impact will that have on the economy in the long run and with our battle with inflation? And I think that's what businesses want to know. What impact will this have on interest rates in the long term? I guess in this instance, I am happy to be a tax specialist and not an economist, so I won't proffer any opinions on that. But instead, let's focus a little bit on what were the major tax changes and who are the winners and losers from a tax perspective. So let's start with some of the winners, Anika. There was a lot made about the future made in Australia, and there's been billions of dollars thrown at the future made in Australia incentives. I must admit I found it a little bit hard to understand exactly what those incentives were and who they were targeted at? Did they apply to specific industries, or was it applied to broader businesses? Can you help us understand what these measures actually target?
Yeah, absolutely. And you're spot on. We've been hearing a lot about this Future Made in Australia concept over the last few weeks. And obviously it's quite a prominent feature in the budget last night. The government's throwing $22.7 billion at it, which is a large sum. And for tax purposes, I'm taking out of it that there were probably two major tax incentives that came out of it. And both of these will actually account for more than half of the funding. So they're quite big incentives. So the first one's a hydrogen production tax incentive. So that's $6.7 billion over 10 years, which is quite a large sum. And the other one is a critical minerals production tax incentive, and that one's $7 billion over 10 years. So exactly to your point, Daniel, it is quite a narrow focus. It's only people that are in that particular sector, which is, the carbon area, which is quite a new sector in Australia. So if you're in that sector, these may apply to you, but on the large, a lot of our clients that aren't in that sector and in different industries, it just won't apply to them. So it's not widespread. It's very narrow, and there hasn't been a lot of detail released about it. So we're going to have to wait coming weeks, the coming months to see, how they're going to administer it, what it actually means for business, how you actually get these incentives and how you access them. So still a lot of detail to come.
And so your average manufacturing business or retail business, it's not really applying to them, even if they want to move to a sort of a greener and lower emissions.
No, they're very, very targeted tax incentives. Okay. But as I said, the devil's in the detail, so we'll wait until that's released.
Yeah, and we also heard reference to the Australian Renewable Agency, and there's a bunch of cash there that's being put aside to be handed out. Who's that going to, and what's the agency going to be doing?
Yeah, and again, it is focusing on that industry group, and there's a lot of measures, a lot of grants that came through in the federal budget, but again, at that very specific industry. So ARENA, which was the group you spoke of, they're going to be tasked with administering all of those different measures, all of those different grants. So they've been given $7.1 million in the budget to essentially administer the government's program across that.
Okay, so we'll wait with bated breath to see where those funds are going. Well, I guess there will be some winners there, albeit in a quite targeted area. Let's move on to maybe some of the losers, and we can talk about multinationals, Christine. They've obviously been a massive focus of the ATO over the last 4 or 5 years. And the ATO have had some success recently in increasing their revenue take from the multinationals. And they didn't escape attention in this budget either. I understand the ATO has recently signalled a clear intention to focus on taxpayers who are mischaracterising payments as royalties. And underpaying royalty withholding tax. So tell us a bit more about that initiative and the ATO's focus in this area.
Yeah. So the ATO have focused on the area of intangibles and how multinationals use them for a while now. Yeah. But most recently, we've had a really specific case come out, which is the PepsiCo case. And the PepsiCo case was focused on basically a structure that avoided royalty withholding tax. It wasn't a big number, like the Pepsi case didn't provide a huge amount of revenue for the ATO, but it was a really important precedent. Along with that case, we've had a tax alert, we've had a taxation ruling, which are really all focused on this area of underpayment of withholding tax. But even with all of that, it was really interesting to see in this budget that they had focused so specifically on this underpayment issue. And so basically the budget has provided for a new penalty associated with significant global entities, so very large multinational companies with turnover of over $1 billion, who enter into these arrangements where they are mischaracterising or underpaying withholding tax. We've already got a regime when it comes to penalties for SGEs, and we know it's pretty
they're quite
nasty.
penal.
Yeah,
Yep.
exactly. They're pretty nasty.
Yep.
And so that's already in place. So it's really interesting that they've called out this very specific area and sort of said, look, we actually think there need to be more penalties around these types of arrangements. It really feels like they've got a sense, the government's got a sense that there are some really egregious situations out there, and therefore it needs this very specific focus. So yeah, interesting. We don't have a lot of detail about what the penalty actually is. So we're still missing, similar to Unica, the actual devil in the detail and what it's going to be, how they're going to apply it, in what situations it will apply. So we're still waiting for that, but definitely interesting that they're so focused on this one very specific area.
I think they've been emboldened by the PepsiCo case. They've definitely had some success there, and I think they want to, spread out to other taxpayers and have similar success.
Yeah.
So just explain a bit more how this could apply, because this is something that, to me is a little bit scary. So we've got an Australian subsidiary of a multinational who, let's say, buys product from a related party somewhere overseas and doesn't pay any royalties, just pays, the cost of goods. How could that be mischaracterised, and how could the ATO impute a royalty on that type of payment?
Yeah, look, and this is really interesting. It's interesting because of the uncertainty in the area, which is the idea that intangibles is something that just provides additional value. So say you do buy a good and it's got a brand name on it, there's a question, does that brand name have value? And maybe before we just thought that was part of the product price. Now the idea that you could pull out part of that value and say, well, really, you should have had withholding tax on that. And so the identification of what is the thing that should have withholding tax on it, but then also what is that value? That's kind of where the transfer pricing element comes in, which is quite grey. So you can imagine for a lot of taxpayers, this is going to create a lot of uncertainty, because they're going to go, well, even if I do think there's something there, how do I value it? And then we've got these really nasty penalties coming on top saying, well, if you misvalue it, then we're going to hit you with a really nasty penalty. So it's certainly creating a lot of uncertainty in an area which is pretty grey.
Seems like it'll be a bit of work for you and your transfer pricing
Keep
colleagues,
us entertained for a
Christine.
while, definitely.
Look, Christine's played bad cop on the multinationals. Let me play good cop for a little bit. There was a measure that was announced in last year's budget, the 22-23 budget, which was intended to deny deductions for royalties that were paid by Australian taxpayers to low tax jurisdictions abroad. There's been a lot of backlash around that. It was a pretty blunt instrument, to be honest. And I am thankful to say that the government announced last night they've scrapped that measure, so they won't be pursuing it or enacting that measure. That's the good news. The bad news is probably they don't need to, is the reality. With the introduction of BEPS and Pillar 2 recently, that will probably cover that type of arrangement. But that is some good news. The other change that does attack multinationals is there does seem to be, I guess, an expansion of the CGT application to foreign residents selling Australian assets. In the past, that was quite limited to taxable Australian assets or taxable Australian real property. The definition of what is taxable Australian asset seems to have been expanded last night. And that's one thing that we'll have to watch. Again, there's not a lot of detail. One of the things that I'm worried about in that regard is that there was a sleeper in last night's budget which said that essentially whenever a foreign resident sells shares that are worth greater than $20 million, they will have to get clearance from the ATO. So it's adding another thing that needs to be done. Sometimes there's FIRB approval needs to be done for these type of transactions, but they will need to go and get ATO notification before those shares can be sold. Before we leave the multinational space, Christine, there's a lot of change at the moment. There's a lot of stuff that's been recently enacted, the stuff that's still before Parliament. Do you want to just remind us of what are some of the key issues that are confronting multinationals at the moment?
Yeah. I definitely think it's worth doing that. We've got probably three that I'm going to touch on. And these are really items that we think are going to impact multinationals. They've been talked about for some time. They're all at different stages in terms of whether they've made it through Parliament or not, but they're things that we talk about really regularly with our clients. And so it's worth touching on because while not specifically in this budget, the whole package of it is going to impact our clients next year and the year after. So Pillar 2 is the first one, which you've already mentioned. So Pillar 2 is effectively implementing an effective minimum tax rate of 15%. It's really targeting those multinationals who are putting profit in really low tax jurisdictions. And the ATO, more specifically the government, has signalled that this is absolutely something they're going to put in place. So we've only recently got exposure draft legislation, but it's going to happen. Yeah. So something for people to be aware of. We're starting to make disclosures in annual reports and statements around the impact of Pillar 2 for a lot of our clients at the moment. So it's already, even though it's not quite there yet, we know that it's coming and we know that we still need to be focused on it. The second one's the change to the thin capitalisation rules. So this is one that's got a lot of airtime for quite a while now. So it was announced in the previous budget, but we've only got legislation passed, I think it was March 24, and then the effective date is the 1st of July 23. So the rules are actually in place, even though we only just got legislation. Yeah. And this is really, we've always had thin cap rules, but this is a change in terms of how they're applied. Something that I'm talking to my clients a lot about. Are you finding, Daniel, it's a topic that's relevant?
Yeah, absolutely. And that is in play at the moment. Broadly, we're moving from an assets-based thin capitalisation test to a profits-based test. We're working through the modelling, with clients as we speak. And, whilst every client is different, the broad thing that we're seeing is that essentially the borrowing capacity or the deductible borrowing capacity for a lot of taxpayers is falling. Yeah. So it is really important to model that so you'll understand the impact of what it means for your tax bill going forward. Yeah. So that is something that is really impacting a lot of clients at the moment.
Already. The last one that I just wanted to touch on is our public country-by-country reporting legislation. Yeah. So again, we've recently got exposure draft legislation around this. Companies or large companies, so again, this significant global entity kind of concept, already have to do country-by-country reporting. The real change here is that they're going to make that reporting public. So there are some changes in that in terms of what information is going to be made public, but it is controversial, especially when you're looking at private groups who potentially haven't needed to have financial information made available in that kind of forum. But again, the government's been really clear. This is something that they want to do. We're only in exposure draft, but the absolute expectation is that draft is going to get through.
Yeah, understand. And that's a focus on multinationals, and every budget, it seems like the ATO's war chest gets bigger and bigger, and they didn't miss out last night either, Anika. So, tell us a bit more about what's been invested into the ATO. They've obviously got, large targets in terms of, raising revenue for the government. What can we expect from the ATO over the next 12 months?
Yeah, absolutely, Daniel. It's all about cash recovery at the ATO at the moment. So last night they released their ATO counter fraud strategy, which is a 4-year strategy, and they're going to invest $187 million in that. The returns that they're expecting are around $302 million. And that's really targeted at tax and superannuation and fraud in those areas. So that will be an interesting one to watch as well, exactly how they're going to do that. And I guess that's just an extension of the 2 previous strategies that they had. So one was the Shadow Economy Compliance Program and the Tax Avoidance Task Force, which they'd previously announced in federal budgets. And then last night they said that there's a 2-year extension for both of those. So it's really showing the government's commitment to the ATO, excuse me, and to really combating that mischief in the economy. And we seem to be seeing a lot more of it. We seem to be seeing a lot more fraud, tax avoidance. So I don't think that that's going away anytime soon. And I think taxpayers, business, individuals, multinationals, both public and private, I think they can all expect to see the ATO, really having a look, absolutely, and saying, let's have a look behind the door and see what's there, and, let's keep undertaking reviews and making sure that what they're reporting is actually correct, and what they're receiving back from the government, they're actually entitled to.
I'm assuming that's a similar thing from multinational space as well.
Yeah, definitely. So slightly bigger numbers in the multinational space, I suppose. So we've got the ATO Tax Avoidance Task Force, and there was additional funding announced for that. So I think they're saying there's an additional funding of $1.2 billion, but the expected payback, if you can say that, in terms of what the ATO expect to collect from it is $2.4 billion.
Wow.
So obviously they're investing, but there is an expectation they will actually get a lot back.
So that'll be coming from someone.
Exactly. And I feel like it's the multinationals, the large private and public taxpayers who really fall within that remit of the tax avoidance task force. And that's, expected in a lot of ways. They've had a lot of success. They've had that task force in place since 2016. And through that period, they've consistently, they have had success in terms of getting additional tax payments in. Because of that success, they're continuing to invest in it. And I think that's not a huge surprise to us. We are still wondering where they're going to spend that money. So last year, when they did announce additional funding for the tax avoidance task force, it was noted that a certain amount of that was going to go to litigation. So we've obviously had the PepsiCo case. We've had a couple of other key cases come out. So we know that some of that money had been kind of earmarked for that process so that the ATO could really put resources into that. This year, we're not really sure where it's going to go. We've got a new tax commissioner. We're not really sure what his focus is yet. So we know there's money. We know they're expecting to get a return on investment, if you can call it that. Yeah, a large one. But the question is, where are they actually going to spend that money? And we don't have that clarity.
So taxpayers will need to be prepared.
Definitely, absolutely.
Look, one of my final questions, as in any budget, it's as much what they do as what they don't do. And, we joked before that there wasn't much in terms of GST changes, in terms of either broadening the base or increasing the rate. What else wasn't touched in the budget, I guess, that, may have been?
Yeah, and just touching on that GST point, as we did say before, it doesn't tend to get much airtime in the federal budget. We weren't expecting too much in there last night, obviously, apart from those, the ATO announcements around the tax task force and trying to recover GST receipts and those types of things. So that was sort of expected that they would extend that and continue on with that. But in terms of increasing the rate or, broadening the base, it needs to get that buy-in by all of the states and territories. Yeah. And as we've seen in recent months, they can't even agree on the GST split. So I can't see that happening anytime soon. It is disappointing because a lot of people out there have said that increasing the GST rate would help with inflation, which may be helpful at the moment. Yeah. And then other people have sort of said, in the current housing crisis, if we tweaked the GST base a little bit, it could help with build to rent. So it is disappointing that GST wasn't in there. Some of the other areas that we didn't see anything in the budget was around employment taxes, so things like employee share schemes. Yeah. R&D didn't feature heavily in the budget.
Keep that going.
I think everyone's happy that it's just sort of business as usual, although they did announce that they would have a look at it and see if they can optimise it and have a look at the system. So they're not saying yet that they're going to make any changes, but they did sort of flag that they were going to have a look at how the system works around R&D, see if they can optimise it, which then goes back to their other areas that they're looking into.
I think it wasn't changed was the corporate tax rate. I know there was talk a long time ago. I don't think that's going anywhere. So that's staying at 30%.
Can't see that happening anytime soon either.
And obviously base rate entities, those with a rate turnover less than 50 million at 25%. The reality is we are falling behind some of our other, neighbouring countries. I mean, UK is at 25% or below. US is 21% federal. They've got some state tax. New Zealand 28%, Singapore 17%. So we are an expensive place to do business, and I think that is something that the ATO and the government need to look at in the long term. One of the other measures I probably should just mention very quickly that's been essentially, the government said they put it in. In reality, it's been removed. Is the instant asset write-off, which was well received by business during the COVID years. That's really essentially been removed except for small businesses now. So businesses with turnover of less than $10 million will be able to deduct immediately assets costing less than $20,000. So that's really been diluted and will have far less application, which is a shame for medium-sized businesses who were benefiting from that. But that is probably all we've got time for. So I need to apologise to the questions that we didn't get to. But let me just leave you, I guess, with one final message. And I say this in my capacity as a tax advisor and also a taxpayer. I honestly believe that the time has long come for this country to have a real discussion about genuine tax reform. Our tax system was designed so many years ago, in an era when the local and global economy looked very different to what it is today. It wasn't designed to deal with multinational trade, global competition, the internet, or the digital economy, and we've sort of tried to fix it on the go. Our tax system is at the moment overly complex. We've got 4 volumes of legislation that we need to deal with. Thankfully, it's all online now. But our tax system is going to come under pressure. I mean, one thing we saw in the budget last night is that over the next 4 years, our budget will plunge into really, really big deficits, which will put lots of pressure on our economy, and some real structural reform needs to happen. And we really need all of our political parties to get together and show some courage to address this in a responsible and measured manner, rather than simply sort of handing out sort of political handouts and putting band-aids on issues that are there. So my final take and my firm view is that only genuine tax reform will allow Australia to unleash its full economic potential into the future. And with that passionate plea, Anika and Christine, let me thank you for joining us today, and thank all of you for joining us here at Grant Thornton. If you have any specific questions, please feel free to reach out to Anika, Christine, or myself, or your relationship partner at Grant Thornton, and we'd love to help you with any of your issues. So thank you for joining us, and have a good day.